So to really talk through chapter 19 and this idea of sales mix, I really wanted to start with just this example and spend some time walking you through this Excel file. Now in Canvas, you have a completed file that has all the answers to it, so you can always reference that as well. But I'm going to take some time to just walk you through this. So the idea with chapter 19 is it's all about using cost volume profit analysis when we are a company that sells more than one product, which for the most case is just about every company. We don't just sell shoes, for example, but maybe we're a golf company and we sell not only shoes, but gloves and rangefinders. So the idea is we can calculate our contribution margin for each individual item, but unless we convert it to a weighted average, we can't utilize concepts such as break even and target net income and even margin of safety without thinking about the company as a whole. So a couple of items of review. Unit contribution margin. We know what contribution margin is. That's selling price minus variable cost or sales minus variable cost. So I'm going to put these in. This is going to be my $75 for shoes minus the variable cost. So each pair of shoes that we sell contributes $16. Same with gloves, $25 minus $12. And then the rangefinder, $250 minus $175 is $75. Okay, so that's not changed. In order, though, to calculate what's known as the sales mix, okay, we're going to do this example based off of total units sold. In the next video, we're going to walk through total sales using sales dollars. So let's focus here. I'm going to sum all of my units sold. Okay, so I'm just summing up all of my products here. So I've got 100,000 total units, total company units. Now, feel free to print this out and follow along or also work through this on Excel. But I'm hoping that by doing this in Excel, you can see the numbers a little bit better and you'll have a smooth tracking to see where all these are coming from. Now, sales mix is going to be calculated by taking each one of our units for each of our products in total divided by the overall. So what that means is that when I look at my shoes compared to the other items that I'm selling, 60% of my sales mix revolves around shoes. Now I can do the same thing with gloves. If I sell gloves, golf gloves, that ratio in my company is 30%. And finally, rangefinders. If my units are 10,000 that I've sold and I compare those to my total units, they make up 10% of my sales. So now when I sum all these together, you can see that my total equals 100. Okay, so I got to make sure that my products individually make up my total units sold. So what does that have to do with weighted average? When we think about it, if our total units are 100,000 and each of these represent the amounts that we've sold, in order to come up with a weighted average, we're going to have to use the sales mix and the unit contribution margin. Now I do that because I'm not getting 100% of the benefit from this $16 of unit contribution margin. I'm really only getting 60%. So when I take $16 times the 60%, really the shoes are giving me across the company as a total $9.60 of weighted average contribution margin per unit. So now I've kind of level set my contribution margins. So that way I can apply some of those CVP concepts we've learned. So I take 10% times my 75 for rangefinders. I took my 30% times my $13 for my pairs of gloves. Now, on a company-wide basis, if I sum these up again, my company-wide contribution margin per unit is $21. So all I've essentially done is reallocated the contribution margins that I've earned across the sales mix of the related products. Now I can move forward to find things such as my break-even units for the company. And then I can even allocate those back to each of my individual products. So if you remember, our break-even calculation for units is to take my fixed cost divided by my contribution margin per unit. Now my fixed costs up here are listed as 690,000. So down here in my calculation, I've got 690,000, and I'm going to divide that by my contribution margin per unit. So now I'm going to look at my break-even units per product. Now, if this gives me my company-wide unit sales that are required, I can now go back and apply my sales mix right here to each of those products to be able to figure out on a company-wide basis how much I need to sell of each product. So 32,000 times 60% means to break even. This is how many pairs of shoes I need to sell. Total company units times my sales mix of 30%, how many gloves I need to sell, and how many rangefinders I need to sell. Now, if I add these up, and I'm actually going to have you just look at something down here at the bottom. I just add up these three, if I can grab them correctly. Okay, see down here where I have the sum of 32,857.14. Now I know that I've allocated everything correctly, because again, remember when I added these up here, the sales mix percentages, they equaled 100%. So this is how many break-even units now I can communicate down to each of my departments and say, these are the goals we need to reach for to ensure that we don't start to lose money. And once I know that, then I can start kind of keeping track of the company and making sure that I know exactly how each company is doing in terms of break even. Since these are the items that I've sold, I just need to make sure that I stay above that to be able to break even per product. Now, let's go ahead and verify this. A couple of review points for calculating totals, okay? So down here, I'm now going to look at my total sales, total variable cost, and my total contribution margin, and just prove out that if my fixed costs are 690,000, that my net income is in fact break even with these units, okay? And remember, break even equals 0 net income, okay? What that also means is that my contribution margin has to be 690,000 to break even, okay? So how do I do that? Well, what I can do is I can actually take my break-even units that I previously calculated and go back to the very top of this, and I'm going to take that times my selling price, okay? So my selling price per unit times my break-even units gives me total sales. I can do that for each one of these. So pairs of gloves, I'm going to take my gloves times my selling price of $25, and I get my sales dollars for break even, and then my rangefinder break even units times my selling price. I can now sum these up, and I've got total company sales needed to break even. Same thing with variable cost. I want to take my same break even units times the variable cost per unit for each one of my products. This is also why I love Excel. I don't have to write these numbers out, and I can make sure that I'm doing the math correctly for you, as long as I grab the right cell. So variable cost is 175. Okay. Oh, that was the right cell. All right. So now I'm going to sum these up. Okay. Now we could do the same thing with contribution margin, or remember, sales minus variable cost gives me contribution margin. So with any luck, if I've allocated my units appropriately, calculated my sales and variable cost appropriately, I should end up with a total contribution margin. Now I can do this both ways. I can either take my total company sales minus my total variable costs, or I'm going to delete this. I can simply sum up my contribution margin for each of my products, which I probably should just to make sure it works. And when I take contribution margin minus fixed cost, I'm broke even. Now, this example focuses on unit sales mix. Okay, we do this when we only have a few units or a lower volume of units compared to a very high volume of units. So if you think about something that would be a high volume of units, think about going into the grocery store. So many different units and products. It's very possible that instead of looking at unit break even, they're just going to look at the break even on a sales dollar basis. And so in the next video, we're going to cover that same example, but instead using total sales.